The APSEC Atlantic Pacific Australian Equity Fund is a long-short fund that was started in June 2013 that invests in Australian shares and derivatives. The last 12 months has been an interesting time for Australian long-short managers, with a number of funds failing to soften the impact of the market fall in February and March. For the 22 open Australian long-short managers on the AFM database, the variance of return between best and worst over the last 12 months was plus 22% to over minus 22%. The Atlantic Pacific Australian Equity Fund was one of the best performers over the period, returning 21.8% for the 12 months to the end of August 2020. But looking deeper into the AFM database, we can start to see where the fund's performance has been generated. The fund has had a negative down capture ratio for the past 4 years, meaning it's generated positive returns when the market was negative. This lack of correlation to the market is further highlighted by comparing drawdowns versus the market, with the fund doing exceptionally well in the large drawdowns of 2016, 2018, and of course more recently in 2020. With an uncertain future for markets, many investors are looking for uncorrelated investments for their portfolios. Today I'm joined by Nicolas Bryon from APSEC to talk about their fund. Nicolas, thanks for joining me.
No worries. Thank you very much, Damen.
The fund has performed very well through the volatility of February and March. Can you give us some insight into how the fund was positioned at the start of the year and how you generated such strong outperformance?
Yeah, sure. I guess we sort of entered the year with a backdrop of relatively high valuations. Typically, that sort of environment where we're not as comfortable, simply because when markets do draw from those environments, they tend to draw quite far, and so generally through the first couple of months of this year, we had much lower exposure, and importantly, as a sort of a strategic lever to what we do, we were hedging off market exposure over weekends, which I'll come to in a minute, which is very important when I talk to both the end of February and through March. So in the run-up to into COVID, we'd had the Australian reporting season. In my view, the expectations weren't met. And so if you have an environment where you have very high valuations without the necessary EPS trajectory to support prices, it sort of makes us very uncomfortable. And so, continuing with the weekend hedge, leading into the 21st of February, obviously, come the next week, we were able to essentially block out that first part of the downdraft through February. But, I think it's probably important to note that in the lead up through the reporting season, we had Italy in lockdown. We had a US administration essentially denying what was going on. Their testing framework was opaque at best, and it was certainly, in our mind, quite heightened risk in the market. And so, having that essentially pick the top on the 21st with our weekend hedge, which we sort of strategically implemented for the year, put us in very good stead for the coming weeks. So interestingly, when you actually go back and analyse the COVID environment, it was essentially the Monday which presented as the biggest draw. Fortuitously or strategically, however way you want to look at it, that's how we viewed markets. And as soon as we sort of get into these environments where market prices are moving fast, it's sort of part of what we do very well. I guess as markets fell, we were witnessing prices and volume start to accelerate to the downside, which sort of brings us to the 23rd of February, which was the start of the week where markets started to bounce. Even though that day was down, we started to see quite large dumping of stock. Saw this in sort of elevated volumes, and I guess if you can't sort of analyse the market in aggregate as to why this is going on, so you know, generally when we're buying, we want to be buying on the back foot, and so we're always looking for panic selling, and that Monday was that day relative to even the prior weeks, and so we saw lots of panic selling. Various stocks hitting support levels. Our accumulation signals were also starting to fire. And so what happens generally is that when these signals start to cluster at any one point in time, it starts to show up a particular market dynamic which could emerge over coming weeks. And so, you know, from an aggregate perspective, around 20% of companies were in this state by the 23rd, which is, you know, from the perspective of the Australian market, had never been seen before. All right, so, you know, generally in market downdrafts, you see maybe up to 10% of stocks in those sort of mean reversion states or near support or in an accumulation phase, but never have we seen 20%. And so, you know, obviously that's unprecedented, you know, relative to the GFC, which was very much a slow grind. Occasionally you had these periods where you had this sort of excessive selling, but for most part it was very much a slow grind. But having that insight to understand the dynamic of the market and this extreme that we're seeing led us to finally lift our hedge. What happens when prices do fall so fast, so quickly? They then, on the reverse side, behave like a rubber band. And so if you pick that day or 2 days, 3 days, in this case, in particular the first two days of that rebound, you capture this enormous amount of alpha. So, you know, for example, Aristocrat was one of those stocks that had been belted. You know, the classic COVID stock where you know, the basis for them earning revenues is people congregating, whether it's around a table or around a poking machine. But even so, at some point these stocks become so oversold that they bounce. And so in the case of Aristocrat, from the 24th to the 25th, bounced 30%. We were lucky enough to buy into that stock on the 24th. So in that sense, you know, because we sort of had this ability to analyse and aggregate the market, knowing what would happen in these severely oversold states, we then started to deploy capital. It's not so much when we deploy capital in those extreme states, because we're always sort of cognizant of the past volatility, that we don't want to be hit on the downside, so just in case markets fail. And so we essentially deployed very little capital. In hindsight, not the best decision, but I guess from the point of view of where we were at that point, that is, we're already making money, market down 30% odd. Deploying a little bit of capital enabled us to pick up these sort of really extreme alpha contributions to the portfolio. And then the rest of March sort of extended, and then through April, May as well.
And, you know, the performance, as I noted earlier, has been exceptional, but you also had similar avoiding drawdowns in 2016 and 2018. What's unique about your process that you think helps you get through these sorts of situations?
Yeah, I guess it, in some respects, comes back to the philosophy of what we're trying to do. It's certainly the case that the strategy is unique in the sense that the outcomes that we've crafted are not seen anywhere else in the Australian market, and I guess we're all proud of that. But you know, at the end of the day, over the long term, we want to be able to beat the market, whether it's via stock selection or market positioning. So in the early days of the fund, where you know valuations were reasonable, and where markets and economies were reflating at that point in time, so this is sort of 2013, 2015, you know, we did quite well. Then we sort of went through this excessive valuation period, sort of amplified by low bond rates, where we sort of started to underperform. But it was sort of a deliberate way of managing money, because we find excessive valuations quite, you know, like the likelihood of fat tail in those environments is quite high. But then again, you know, as you highlight, the periods where we go through distressed environments, you know, we come into our own due to the experience of managing these sort of major downturns. Whether it's, you know, us putting on our trading hats or being able to interpret the macro environment better than others. I guess at the end of the day, the philosophy internally is that, you know, if we do foresee a market sell down, you know, over 2%, then internally we think we must beat the market. All right. So, you know, it's all well and good to be a long-only manager and buy good companies, which we do quite well as well. But when environments become distressed, if you have the tools to manage that risk, then why not? So that's what we do. So, you know, in terms of the track record since inception, there's been, I think, 18 occasions where the market's been down 2%. On 17 occasions, we've outperformed. So, I guess in sort of a broad summary, if we focus on the upside, where the risk reward is favourable, so where valuations are appealing, and we manage the downside, we're actually able to craft some very attractive return profiles relative to everyone else. So it's not so much about beating the market, which is always a good thing, and we certainly strive to do that over the long term. We also focus on volatility. All right, so you know, we went through this approval process with Zenith recently. Recently got approved. They bucketed us into a certain component of the hedge fund space in Australia. But if you actually review our returns across pretty much all long-short funds, not one showed a near zero correlation with the market. So probably from our point of view, that's actually quite a powerful indicator of our capability, in the sense that, you know, over the long run, we have very little correlation with the market. We beat the market, but we also deliberately attempt to reduce volatility.
So with reasonably uncertain times still ahead of us, how's the fund positioned at the moment, and how do you see the market going forward over the next 6 to 12 months?
Yeah, good question. I think there's a range of macro events that are looming. Obviously, the US election, depending on, you know, what the score is on Biden versus Trump, that will create its own volatility. The extent to which valuations have sort of crept up again, even looking 2 years out, 3 years out, still quite ritzy. in the scheme of things. So generally, we would be very conservative in terms of our positioning. We will maintain the weekend hedge because, you know, when markets aren't open and we're not awake, we don't want to expose our investors to potential fat tails. And then, you know, as weeks progress into various events, we'll probably open up the book. But you know, there's a few individual stocks that may also provide some alpha to the portfolio. But yeah, generally we're sort of bottom pickers. And I guess in sort of the current environment, you have to be quite patient. But you know, when stocks have been so oversold, you know, generally the risk reward is in your favour as that segment of the market reflates. Generally not in tech. You know, the valuations are extreme. And yeah, that won't be driving our returns, other than maybe relative returns.
Well, as I said at the start of the video, you know, I think a lot of investors need to think about lowly correlated or uncorrelated investments in their portfolios, and certainly you've done an amazing job, really since inception, but certainly in really poor markets at various spaces in time. Nicolas, thanks for your time this afternoon, and good luck in the future.
Thank you. All the best.